Hello and welcome to the BDO Talking Trust 2021 series. This is episode 1 of a 4-part series which aims to bring clarity to the purpose and application of trusts in wealth management. In this year's series, we host experts in tax structuring, trust law, and family business governance who will share practical advice, guidance on how to use a trust and how the family can work together for a family legacy and long-term wealth creation. I am Ricardo Teixeira, Chief Operating Officer at BDO Wealth Advisers, and I will be your host for the Talking Trust series. Thank you for joining the conversation. Last year's Talking Trust focused on helping you navigate your duties and responsibilities of being a trustee. Our discussion topics in 2020 covered the trustee's role, taxation of trusts, exploring tax structuring opportunities, as well as the best practice in trust governance. If you missed the 2020 series or you would like to have a refresher of these topics, you can view all 4 episodes on the BDO YouTube channel or directly on the BDO Wealth website. This year, the Talking Trust series extends the conversation and aims to bring clarity to the opportunities, the challenges, and solutions on how to get the trust working for you and your family. Today's webinar will be recorded and added to our website and the BDO YouTube channel. We have set aside time for an interactive Q&A session following the talk. So if you have any questions or if there are any areas that you would like clarification on, please do line up your comments and questions by using the Q&A function. And you'll find this on the top right-hand corner of your screen. Just look for the speech boxes that has a question mark. BDO has been providing professional audit, advisory, and tax services to families and businesses for over 60 years in South Africa. And to be candid, we've seen a lot of trustees and families struggle with optimizing the family trust for wealth creation. Trusts are, however, wonderful vehicles. By having the right solutions and processes in place, a trust can be extremely beneficial to a family's wealth creation and protection. A trust is a unique structure, though, and certainly far more complicated in managing than compared to a company. And there are many nuances to maintaining the validity of a trust. So as a result, any shortcoming in managing the trust, no matter how insignificant it may appear at face value, may have devastating consequence on the original purpose and intent in establishing the trust. Our objective in hosting the Talking Trust series is to bring clarity, awareness, and knowledge to the best practices and opportunities for effective governance and administration of a trust. We start off the series with today's topic, the role of the family trust in wealth management. Trust can be a valuable instrument for estate and succession planning, but there are many pros and cons to consider before making the final decision on whether a trust is the right vehicle for you and your family. Our guest speaker today is well qualified to talk about financial planning for trusts. He's a chartered accountant and a certified financial planning professional with 30 years experience in advising high net worth families on all aspects of their wealth management, including tax and financial planning. During his professional career, he worked with SARS and the Ministry of Finance, where he gained a passion for and an intimate knowledge of the South African tax legislation. This eventually led to his appointment as a tax partner with BDO South Africa, before ultimately establishing BDO's wealth advisory practice in 2004, which he continues to lead as managing director. He's passionate about helping people get to the right solutions so that they create their own personal masterpiece. Please welcome Alan Heynen.
Thanks, Ricardo, for that introduction, and welcome to all of you to this webinar today. I'm pleased to share various insights that I have gained over my 30 years, as Ricardo refers to. I know that there are different people on this call today. Some of you are perhaps considering establishing a trust. Some of you have had a trust in place for a very long time. Others of you are perhaps thinking, oh, well, should I be winding up my trust at this stage? So I'm hoping that in this half an hour, just to give you some topical points for you to consider, and hopefully that gives you some ideas to take away with you. And we're of course happy to engage with you and address any questions at the end of this webinar. So if we have a look at the concept of trusts, I think it remains an excellent long-term mechanism for protecting and transferring the wealth of the settlor. But it's also quite clear in my mind that the trust is not suitable for everyone. It was a case of 20 or 30 years ago that it was a must-have. Everyone had to have a family trust. A lot has changed in trust law, in tax law, and in governance, where it doesn't make it suitable for everyone. So I thought I'd start off with just unpacking the pros and cons. So let's start with some of the positives. Why would you consider a trust? And is a trust still useful? Well, I think my first thought there is that the trust remains a very good mechanism for transferring wealth to beneficiaries of a trust. And if I just take a very simple example, if you accumulate wealth all in your own name, and you want to then assist children later in life, for example, with putting down a deposit on a property, you can't just give R1 million to a child or a family member without that incurring donations tax. If you have set up a trust, that trust can then make distributions to a family member. That's not a donation. So it's a very effective way of transferring wealth. And the same happens at death or termination of the trust. If the trust must be terminated, very good mechanism for transferring wealth to the beneficiaries. A second reason that's long-standing and always remains in place and sometimes discounted is that a trust offers very good protection from creditors and creditor claims. Anything in your own name, if you get sued personally, any personal assets are subject to attack, but assets held in a well-constituted and managed trust are protected. They are not your personal assets. And then what I've certainly seen in recent years is that a trust gives fantastic protection for beneficiaries. So we find that often not everyone is able to manage money well. There's unscrupulous people out there trying to get hold of people's funds, and to have a second layer of governance where a beneficiary doesn't make that call directly, but where queries go through to a trustee is very, very handy to have. I'll unpack that a little bit more in this talk. And then 3 tax reasons. Up to now, I haven't spoken about tax at all. But the first one is that the buildup of wealth in a trust is excluded from estate duty of the settlor. So for all of us at death, anything in your own name is subject to estate duty. And there are, of course, some exemptions, but any trust asset is excluded from estate duty. So that's a significant saving. 20% of assets, and recently increased for estates over 30 million, 25% applies to asset value over 30 million. So to the extent that that asset growth is held in a trust, that's not subject to estate duty. The second tax benefit is that the Conduit principle of tax applies. And I'm going to talk through an example about that a little bit later, just to illustrate that, because that at present is still a very attractive benefit for trusts. And then one that is overlooked is the shielding of capital gains tax on death. I just mentioned that we all have to pay death duties at death, but since 2001, when capital gains tax was introduced, all your assets are also deemed to be sold at death. So whether they are disposed of or not, just the fact that they are in your estate triggers the capital gains tax. And we've seen some eye-watering numbers in our administration of estates that we deal with, where you have very high growth assets in your own name. You are firstly subject to capital gains tax on those assets at death, and then what's left, you're then subject to estate duties. So in that instance of very high growth assets, you could easily find that about a third of asset value is eliminated at death, which creates all sorts of problems apart from the actual tax charge, but liquidity events and the like. So those two impacts do not directly impact on trusts, CGT and estate duty at death, and that's very much a clear reason for why one would consider a trust. So just on those couple of pros, you're all excited, you think, well, we should definitely all have a trust. But why do I say a trust is not for everyone? And let's look at some of the cons. Well, the first one, and I think which is also often overlooked, is the loss of control by the founder. If you're a control freak, then a trust is not for you, because you are divesting yourself of those assets. I think there's enough case law, which other speakers will talk to in the series, about beneficiaries turning on the founders or the donors and trying to control the assets. And I always get cold shivers down my spine when people talk about my trust. No, it's not your trust. Okay? It's a separate trust that's no longer your assets. When you transfer assets across into a trust, you may have a loan account, but any growth is no longer yours as the founder. You divested yourself of that. And a lot of people are uncomfortable with that, and don't want their destiny to be in the hands of others. Then if that is an issue, then it's not for you. As attractive as all these other things may be, the fact that someone may outvote you one day and award certain trust assets to a beneficiary that you do not agree with, then that's what you live with in a trust structure. So the second con is that the tax laws are always changing. I mentioned on the pros that there's some very attractive things on trusts, why you would consider a trust, but that the tax laws have been evolving and they will continue to evolve. So you don't establish a trust just for tax purposes, because you will be affected at some point by changes in the tax dispensation. The third reason just to consider a trust is compliance costs. Again, 30 years ago, people formed a trust. They didn't register the trust for tax at SARS. They just formed it at the master and then just carried on all merrily. Well, laws have changed significantly with that. You wouldn't be able to register a property or an investment without a tax number. You've all heard of FICA nowadays. There's the FATCA regulations, all sorts of regulations that apply to trusts as well. When I first dealt with a trust tax return, it was 4 pages long. I think you're lucky now if you get away with 20 pages after you've answered basic questions, because you have to report so much on every participant in the trust, the founder, the beneficiaries, the funders, all have to be reported on. And there's a cost to that. You need to prepare annual financial statements for the trust. That's always been a requirement. It wasn't always done in the past, but in this era that we live in today, trust and accounting and tax compliance is all important, and that all comes with a cost. And then lastly, it's not easy to establish new trusts, and I will unpack that a little bit in this talk, in that particularly the changing tax laws make it difficult to transfer assets into trusts. You need to have independent trustees, which is quite rigorously applied now by the Master's Office. And all of that may get you to reconsider whether trust is for you. Well, let's get into some of the nuts and bolts. And I just want to look at a little bit of the tax implications. The Davis Tax Committee was established to look at various aspects of tax policy framework in South Africa in 2013. And they delivered numerous reports. But the one that I'm interested in for this talk is the report that they released on estate duty in April 2016, where, and I just touched on 2 matters, where they spoke about the Conduit principle of taxation, which they recommended that it be largely removed. And their second recommendation was that interest-free loans not be tampered with too much, the funding mechanism for trusts. but they did make some suggestions of how interest-free loans that fund the growth in trusts, how those be attacked. The Treasury didn't listen to those aspects of their recommendations because they left the Conduit principle of tax in place, and they attacked interest-free loans by what is now known as Section 7C. So let me just explain to you what is the Conduit principle of taxation. On the screen here, you've got tax rates that apply to trusts, and then I've given you those for individuals. So if you just look at tax rates, you'd say, well, a trust isn't attractive at all. You're paying 45% income tax in a trust on taxable income, whereas an individual pays anything up to a maximum of 45%, but you only reach that 45% at income of over 1.5 million, whereas in a trust you pay that from brand one. The capital gains tax rate in a trust is double that of the maximum rate of individuals. There's no threshold in a trust, there's no interest exemption, and there's no CGT exemptions. So what does that mean? Just by way of example, in a trust, if you had net interest income of 330,000 in a year, and you just left the interest in the trust, you pay 45% tax, which works out to 148,500. So let's illustrate what the Conduit principle means using that same example. So instead of the trust retaining the 330,000, the trustees gather at their annual meeting and they say, let's distribute that income to 3 beneficiaries. We've got 3 beneficiaries. The one's a varsity student, the other one's unemployed, and we have another beneficiary who has no other income. So let's give them 110,000 each. So the trust then pays no tax because the 330,000 income has been distributed out. And the column for individual beneficiaries looks at what's the tax for each beneficiary, because they need to declare that receipt from the trust in their personal tax returns. So they each receive 110,000 Rand. They do qualify for the interest exemption. And if that is their only income, being that only from the trust and they have no other income, taxable income for the year, they would end up with a taxable income of 86,000 Rand, which is below the threshold, and they would pay no tax. So I think a simple example, but it illustrates how valuable the Conduit principle of taxation is in trusts. From paying 145,000 on 330,000 income, you can make some decisions regarding distributions to beneficiaries and result in no tax payable in this example. So let's look at the other section that the Davis Committee dealt with, Section 7C. And what I've given you here is an example of a traditional balance sheet of a trust. So I've got here a trust that just has an investment portfolio that's built it up over years, sitting at 10 million Rand. And it was funded by a loan from the settlor. So the settlor loaned money for the trust to make investments of 8 million. And since the original investments were made, there's an accumulation of 2 million Rand in the accumulated trust fund, which has come from accumulated profits, dividends, interest, etc. That 2 million Rand, going back to the concept of trust, is excluded from the settlor's estate and it belongs to the trust. But this was a traditional method that was used for many, many years in transferring wealth into trusts. And this is what Section 7C of the income tax seeks to address. To say, no, that's not fair, SAR says, because we're losing out on estate duty, because we get estate duty on the 8 million, but we get nothing on the 2 million. So let's discourage people from using the structure. And the law that was implemented was to say that if you have a loan to a trust, you need to charge interest on it. And if we look at that, the calculation of that, on the 8 million Rand, you need to charge interest on your loan at prescribed rates as levied by SARS. Now, those rates have almost halved over the past year because they are linked to market-related rates. And you're all aware that interest rates have collapsed post-COVID. So this rate was well over 7% a year ago. It's now 4.5%. So as we stand right now, if you make a loan of 8 million to a trust, you have to charge 4.5% on that loan, which is 360,000 rand. So you need to charge 360,000 on that loan. The trust may claim it as an expense. It may or may not be tax deductible depending on the assets in the trust. But the donor or settlor who advanced that loan has to declare the 360,000 rand in the tax return. So if I'm the funder of this trust, I have to declare the 360,000. If I'm at a maximum tax rate of 45%, I need to pay 162,000 in tax. So, and that's every year. I have to do this calculation every year. So quite a significant change on having an interest-free structure that applied for many years. There is an option here. If you don't want to charge the interest, then the interest that is foregone is deemed to be a donation. So you can agree to the trustees and saying, I'm not going to charge interest on my loan. You still need to do the calculation then, and you have to pay 20% of the interest that would have been charged as the donations tax. So in this example, I don't want to charge 360,000 on my loan. So I submit a donations tax return, and 20% of the 360,000 gives me a donations tax of 72,000 that I need to pay. That's for the privilege of having granted an interest-free loan to a trust. And this is again applied on an annual basis. That lower interest-free rate does make a difference to how much you can have as an interest-free loan to a trust, because every natural person has 100,000 rand donations exemption. So when we did these calculations a year ago, it worked out that you could have a loan of 1.2 million to a trust without having to charge interest on it, and the deemed interest would be covered by your donations exemption. Because interest rates have reduced, that loan limit has now gone up to 2.2 million. So that you can have 2.2 million per person of loans to trusts on which you would not trigger the annual donations tax. So that's some good news. That's filtered through over the past year. So this example applies to a lot of new trusts. Why people are reticent of setting up new trusts, because you can't have a trust and just suddenly have 10 million of assets. The trust needs to acquire them, and traditionally it would have had the interest-free loan. The interest-bearing loan is unattractive for people who don't want to bear that cash flow cost every year of the tax or of the donations tax. But of course, it doesn't apply to long-standing trusts who have eliminated the loans over the years, either by repayments to the funders or the donors. So this does not apply, and that again shows how valuable older trusts are that have accumulated wealth within the trusts. So I focused on the Conduit principle at section 7C. Let me just at high level talk to some other tax considerations that you need to be aware of in trusts. First one that I come across quite often now, because we live in a global world and many trusts have beneficiaries that live overseas. You do need to be aware of distributions to non-resident beneficiaries and to take tax advice for that. Because, for example, the Conduit principle does not apply to capital gains distributed to non-residents. So you may have two beneficiaries, one resident in South Africa and one resident abroad. If you award them both capital gains, so you make a capital gain in the trust, you don't want to pay the 36% rate, so you award it to the SA resident, which would get taxed on a sliding scale up to a maximum rate of 18%. But if you make that distribution to the non-resident, that income is taxed in the trust at 36%. So be aware of that the Conduit principle doesn't apply across the board. You do need to look at each one's situation. A positive consideration is testamentary and special trusts. This is one, if you want to have a trust, having one formed through your will, where you have a testamentary trust, is hugely beneficial if you have minor children. So a testamentary trust is classed as a special trust if it has any one beneficiary who is alive at the death of the testator, who is under the age of 18 years. So you could have a special trust running for almost 18 years. And the advantage there is that it is taxed as a natural person. So you don't have that higher tax rate, which are set out for trusts. The tax rate for natural persons applies. So that could be very beneficial for a period of up to 18 years for testamentary trusts. And then a comment on endowment policies. Endowment policies are used widely in financial planning because they just make life so much easier. You don't have to analyze annual IT3 certificates. The tax is all dealt with at source. You pay where there are natural persons as beneficiaries in a trust. The endowment pays tax at 12% on capital gains and 30% on income tax. Now, if you have beneficiaries who have high tax thresholds and you can't use the Conduit principle, then that endowment is very attractive because you're paying CGT at 12% rather than at 18% in the endowment, and tax at 30% rather than 45%. But you do need to analyze the tax position of your beneficiaries. If your beneficiaries are students or unemployed or don't earn taxable income, they may just earn dividend income or other non-taxable income, then an endowment policy may not be suitable because you don't want to volunteer to pay 12% CGT or 30% income tax where your beneficiaries are at lower tax rates than that. So just a point to look carefully at applications of endowment policies in trusts. And then lastly, I'd like to just talk about the trust as a planning vehicle. So apart from tax issues, I think there are a lot of non-tax issues of why you would use a trust as a planning vehicle. But again, just a few things to be aware of. The first is on foreign assets. Now, again, this is very topical because as SA residents, we get foreign investment allowances, and we find that most people have taken advantage of that and are building up offshore assets. You need to consider how you deal with your foreign assets. A South African trust cannot have hold foreign assets. The foreign investment allowance is restricted to natural persons, and up to a short while ago, a local trust could not inherit foreign assets. At death, the foreign assets could not be transferred to a local trust. That can now be done on application to the Reserve Bank to have the local trust own the foreign assets. But I would really caution that and think about how do you want your foreign assets to be held over the long term. The whole idea is for diversification away from South Africa. Does it make sense to have your South African trust owning foreign assets, South African trust that's subject to South African tax laws, South African trust laws, etc.? Is that the right vehicle to hold your foreign assets? I'm not wanting to give any answer here because I think everyone's situation is different. But what I have found is that not many people are giving thought to that, on how to deal with the offshore assets held in personal names. Something else that to give thought to is, what do you put in a trust? And I've seen all sorts of trust vehicles over the years. Those set up to hold motor vehicles, furniture, shares, or just a family trust. In my view, and I have more simplistic view, but I think that one holds a trust just for growth assets. If you look at the examples I've shared with you, the big advantage of a trust is that you're saving on long-term estate duties and on timing of capital gains tax. So you wouldn't want to put an asset into a trust that depreciates in value. So for me, having a motor vehicle, unless you're trying to really protect a beneficiary, but a vehicle that will depreciate in time, to me, is not a trust asset. Business assets, properties, investment shares that have a long-term growth mandate, those are suitable for trust assets. And then I want to talk a bit about using a trust to look after beneficiaries. And I think this is probably the most advantageous reason for holding a trust. If I look at my experience over the years in dealing with trust beneficiaries, the reality is that a lot of people are not able to manage money. So a settlor sets up a trust, puts a board in place of trustees to manage it and to give guidance to beneficiaries, perhaps just for a period of time. Sometimes it's 5 years or 10 years, but for some beneficiaries it may be indefinitely to look after their interests. We've also found that for a lot of beneficiaries in trusts, they actually use it to their advantage, where they may not be able to say no to a request to a distant family member or friend who comes and says, "Oh, please, Joe, can you loan me R1 million?" Some people can't say no or don't know how to say no. It just pulls on their heartstrings. A wonderful thing is just to say, "Sorry, I must consult with my trustees," and the trustees will have to get back to you. I'm very happy to make that call to the long-lost relative and say, unfortunately, the trust is not in a position to advance those funds. But it's not easy for the individual to always say that. Okay? Just as making investment decisions, beneficiaries sometimes need to be guided, particularly if they're not used to dealing with money. And I think back to stories here of where we as a firm helped a lot of the lotto winners when the lotto was first introduced in South Africa. And I can confirm that about 90% of lottery winners have no money left after 5 years, because you're just overwhelmed by making decisions, and you need guidance. And if you don't buy into that guidance, then it's just not going to work out for you. And I see the same with a lot of trust beneficiaries. If they're not used to managing wealth and they suddenly get unleashed with huge amounts of wealth or assets, they haven't had that training over the years to get used to that, to making those planning decisions. And guidance is very, very valuable. So I've seen wonderful success stories where trust has been used to great effect to protect family members. So if I had to single out one single most important reason for having a family trust, is to give that assistance and guidance to the greater family. And then lastly, what is very much overlooked, much to our dismay, is the reviewing of trust deeds. A lot of people set up trusts 30, 40 years ago, but with the inflection of time, so much changes. You may have set up in your trust that the beneficiaries are your children, but now you have grandchildren, you may even have great-grandchildren. What about them? Were they included in the class of beneficiaries? Because only the class of beneficiaries may benefit from the trust. What about forced termination? When you set up your trust, did you have a forced termination? Is that still relevant? Bearing in mind that capital gains was introduced in 2001, if you have a forced termination of your trust, you also have forced capital gains tax when the trust is forced to dispose of those assets. You need to review the trustee to make sure that is dealt with. So we are going to cover this. Via van der Spey is going to cover this in a lot more detail in the 3rd episode of the series. And I would encourage you to dial in and listen to that webinar. which will talk specifically about trusts as a vehicle in the Talking Trust series. But Ricardo, I think I will leave it there, and I'm happy to take any questions.
Thank you, Alan. Thank you very much for the succinct, I think very insightful summary of the financial planning considerations in terms of using a family trust. You've really given a lot of food for thought around what one should be considering. I see we do have a couple of questions, Alan. If I may just ask you to let's reflect on those. The first question that we received was, per my mother's will, we need to create a trust for the money that she left for her 3 grandchildren. So I'm assuming a testamentary trust. Can my brother and I be the trustees?
Right, Ricardo, we first of all need to go look at what was the terms of the will. So the mother would have appointed the trustees in the will, and they would need to accept, and there should hopefully be a provision for replacement of trustees. So if the will makes provision for that, the individuals may have been appointed directly. If they weren't, the other trustees get appointed by the master. If it's a case of those trustees, the family don't want those trustees to be appointed, that will become a negotiation. So are they prepared to resign? And can the other 2 be appointed in their place? Just something that FIA, I think, will definitely talk to is that what may be an issue is the appointment of an independent trustee. We see that in any trust appointment with a letter of authority, the master wants an independent trustee, so one that is not connected to the family and has no interest in the trust, to almost be the adjudicator, as it were. And again, because of bad publicity and trust cases where family members took decisions and they had vested interests as trustee and beneficiary.
And that would apply to testamentary trusts equally in terms of having an independent trustee in the formation of that testamentary trust, Alan?
Yeah, I think if there was a change, so perhaps not with the initial appointment, but certainly on a change.
All right, good. Yeah, so I think that's a great question. I think it really just lends, like you said, to the fact that the will is really the trust deed in this instance. And I think we've seen practical examples where wills are poorly drafted, which leave very little discretion, very little power for trustees. So it is actually quite an important question that's been posed here, and I think a lot deeper around the drafting of the will in the formation of a testamentary trust. Thank you, Alan. A question that's been asked is around tax. If I just repeat it, is what protection do trusts that are set up for today have from changing tax laws? South Africa is taking an ever aggressive approach to taxing wealth, and so do trusts even have a future in South Africa wealth planning?
Yeah, excellent question, very topical, because I think, as I mentioned in my cons of trusts, is that you're living in an evolving landscape. So the trust laws can change, and they will change on an ongoing basis. But what we've seen in the past is that it's not done retrospectively. So certainly if you have I'll break it down into 2 separate components. If you have a new trust, you're going to think carefully about that because you haven't got any wealth in the trust. If you have an existing trust, you've already had a lot of benefit. So if the tax laws change in future, yes, that may affect the future taxation of the trust. But unless there's retrospective taxation changes, you still have the benefit of what you built up in the trust in the past and what's excluded from the settlor's estate. But I think, Ricardo, that also comes to the drafting of trust deeds. It's important to, if you have those concerns, to have an escape clause. So if the trust is no longer relevant or the tax consequences can't be lived with, that you are able to wind up the trust. And that you're in no worse a position that you were than if you didn't have the trust to start with.
Wonderful, thank you, Alan. I think that is quite clear, and it does again highlight the importance of the drafting of the deed. I think we see it time and time again in the fact that actually the deed is the governing document. There is no trust act that governs the trust, other than very, very superficial sort of law, but it's really the deed that determines it. So yeah, thank you, Alan. I think this leads to the next question, where it's been posed that do financial statements of the trust need to be audited?
Yeah, I'm going to refer that back again to the trust deed. So we have seen many instances where the trust deed compels audit. Then you have to have the trust audited, but it's not a requirement. So to have the trust audited, but your trust deed just needs to provide for that, just to say that accounts need to be produced by an accountant. If it's silent on the audit, you don't have to have it audited. If it says it must be audited, you have to have it audited.
Correct. Thank you. Sticking with the question of a testamentary trust, Alan, would estate duty still be paid if there was no trust established at the time of death? So just interpreting the question, I'm assuming that a trust was not defined within the will. The question is really, would estate duty still be paid?
Yes, you would still have estate duty on all the assets in the name of the deceased. So if the deceased creates a trust, the benefit of the trust is only going forward from that point onwards. So if in my estate, if I give you an example, I have an estate of 10 million rand. That estate is subject to estate duty on that sliding scale with 20% above 3.5 million rand. Okay. If I then leave my whole estate to a trust, the 10 million rand less the taxes becomes the starting point. So there won't be tax again on estate tax for the beneficiaries of those assets.
Okay.
That answers the question.
I think that does, and again, Alan, I think it picks up on the advantage that you spoke about earlier around the CGT shielding on death, which is often so overlooked, that at the time of death, one's wealth and estate is deemed to have been disposed, triggering a CGT event. And so having it within a trust creates that automatic shielding, because the trust doesn't die. There's no deceased trust. I think it's a lovely question, I think, to reflect on. It does roll over to the next comment that was made, Alan, and it's really, I think the comment is really around the fact that there is an importance of having a financial planner, certified financial planner, consult and discuss whether a trust should be created as a vehicle. What are your, how would you guide a family in that conversation, and what are the considerations that they need to be looking at in terms of establishing a trust for their wealth, for their family wealth management?
Ricardo, yeah, I think a certified financial planner can add a lot of value in that discussion. Depending on how you want to structure the trust, may also be useful to get tax input, and perhaps from the family accountant. Depends on the assets that you want to put into that trust. But if you're dealing with a trust that wants to set up investments, I think a financial planner is a very good starting point to at least identify the issues, and then you can call in the further experts as may be required.
Correct. I think you absolutely. I think you make a good point, Alan. It's about identifying the issues. So it's not necessarily a checklist. It's not necessarily there's a playbook to work from. It's actually looking at understanding the family's position and scenario, and like you said, creating and identifying where there are gaps or opportunities to structure effectively. Thank you. Alan, reflecting on testamentary trusts again, if once a child or the beneficiaries reach majority, so they're older than 18, what would happen to the assets in the testamentary trust? Would they remain, or what would you do with it? Is really the question.
Yeah, so that special trust rule is only a tax rule, so the assets always remain. So the testamentary trust is set up at death. The assets are transferred to the testamentary trust and administered for the family members identified as the beneficiaries. And then until the youngest person is 18, you'll benefit from those special tax rates. As soon as the youngest beneficiary is 18, you just lose that tax dispensation. Then you go back to the normal tax dispensation. So if the trust runs for, say in this instance, it was formed when the child was born, then it can run for a maximum of 18 years. So from year 19 on, you just become subject to the normal tax dispensation. So the Conduit principle still applies, but anything that applies that is left in the trust is taxed at the normal trust rates, not the favourable rates.
Okay, wonderful. Thank you. Moving to interest-free loans, how are interest-free loans to foreign trusts taxed, Alan?
So that is not dealt with under Section 7C. That's more transfer pricing regulation, and that's dealt with in terms of Section 31 of the Income Tax Act. And that can be a bit more complex. I think that our tax partners are more qualified to deal with that. But in essence, it means that you need to charge a fair market-related interest rate. So it also provides for that an interest rate needs to be applied to loans to foreign trusts, but under a different tax section of the Act. The 7C that I spoke about in this webinar doesn't apply to foreign trusts.
Okay, lovely. Thank you, Richard King, for your question. Alan, Richard asked, on termination of a discretionary trust, in terms of the deed of trust provisions, may certain beneficiaries be excluded in the final distribution?
Yes, well, again, I'm going to refer back to the deed. Depends on the deed, but if it's a discretionary deed, and the provisions say that at termination, the assets may be distributed at the discretion of the trustees, then that allocation may be varied. It doesn't have to be equal. And again, we've seen that in various trusts, that it's not equal distribution. The trustees can decide, again, subject to the trustee permitting it, on who receives the final assets.
Okay, excellent.
And that is often the case, where from a cost point of view, it's no longer viable to maintain a trust, but the primary beneficiary, for example, is the parent. Then all the assets would get distributed to the parent to the exclusion of the children.
Okay, so quite a practical question, a practical scenario that could actually play out in terms of the distribution, provided it's drafted in the deed.
Yeah, always have to go back. You always have to go back to the trust deed, which is not a template. Every trust deed is different. So that's why we really encourage looking at that document, saying what is permitted, what is allowed,
Yes.
and what are the obligations of the trustees.
Absolutely. Alan, a question around professional trustee, and I'm assuming that really the scope of that question, of this question, is around the independent trustee. Can you please sort of elaborate on what the fiduciary responsibilities are as a professional trustee?
Well, I don't think it detracts from the duties of all the trustees. Again, all the trustees have a duty of care and skill, acting in the best interest of the beneficiaries, and for and again, in terms of what the deed provides. But I think the concept of the independent trustee was really introduced by the master, that it is for someone who does not have any vested interest and who can be a clear thinker and be the arbitrator sometimes, we see, because the other trustees are often linked to family members or to the beneficiaries in the trust. So no, not in trust law, there isn't any specific obligation, but just in terms of that appointment that's required, I think it's more the role that the trustee serves. But the duties are the same for all trustees.
Absolutely correct, yeah. And I think that's a very important point, is that regardless of your relationship to the founder, the trustees have very well-defined responsibilities and roles to play in terms of the fiduciary responsibility. Thank you, Alan. There is a question around fees for the setup and administration of trusts. Is that something that you could quantify, Alan, or is it just sort of broad, maybe a broad guidelines and comments around that question?
Yeah, Ricardo, I think that varies so much. It depends on the process that you go through. You know, how some people have very in-depth consultations about setting up a trust. So most professionals charge on a time-based scale for setting up trusts. A lot of legal firms specialize in that. Some advisory practices do that. But I wouldn't want to put a number to it. But I don't think you can do much into the establishment for under, if I was forced to put a number on it, for under 10,000 Rand for establishment, for very basic. But then you've got to think of this additional cost. You've got to register the trust as a taxpayer. You need to open bank accounts.
Okay.
So there's a lot more onerous requirements today than years ago, where you just signed a trust deed.
Absolutely. Correct.
The scope of the engagement is also a lot wider than just establishing a trust.
Thank you, Alan. If I can build on that, Alan, I think in terms of the administration, what we've seen in practice is that administration really is quite it covers a broad area of functions, and that includes not only the governance of the deed and what trustees need to comply with, but also the preparation of financial statements, as well as submission of tax returns. I think all those elements, as you've spoken about, have an element of professional costs attached to them, and often they link to the complexity of the trust and the volume of transactions and activity within the trust.
Agreed. Yeah.
Perfect. So I think we're going to close out really just with one more question. I think we've had a really good engagement. I thank you for the questions. And if there are any further areas that you'd like clarification on, please continue to post them in the Q&A or direct your emails to BDO, and I'm happy to answer them. The one question we'll end off here is, in what situations would creditors, for example, a bank, have the legal power to disregard the trust and pursue the trust's assets? So really the question from Dean, thank you, Dean, is really, in what instances would the trust be, I suppose, the veil be pierced, Alan?
Yeah, so and I'm assuming here that the bank hasn't got any lien on the trust assets, which sometimes they do have, but assuming there's no lien on trust assets, how could they attack the trust assets? And that would be to say that if they're going after the assets of the settlor or funder, I'm presuming that is in this instance,
yes,
that you're dealing with a sham trust, that it is just the persona of the settlor, and he really dominated the trust and ran the trust as his alter ego. They would have to go through a process, we've seen that, so where they need to go through a process to prove that. So the best way to avoid that is to make sure that your trust does stand on its own feet, and that the family trust has annual accounts done, has annual meetings of trustees, has minutes, because that all gives proof, where if you do have to go to court with a bank to say, no, here was my annual meeting with trustees, the trust is not an alter ego, it's not my assets, it's administered separately for the benefit of the beneficiaries. That's your best defense.
Absolutely, yeah. Thank you, Alan. Yeah, and I think you're absolutely right, and that's what we see time and time again. It's really that attention to detail, and as we've spoken about before, it's those nuances that really make the trust valid, or like you said, an alter ego or sham. So, Alan, thank you so much for your time. Thank you for your insights that you've shared. It's been wonderful having you and hosting you today for this talk on the role of the family trust in wealth management.
Thanks, Ricardo. Thanks for inviting me.
Wonderful. Thank you, everyone, for joining today's conversation. This webinar has been recorded, and a link to the recording will be made available on the BDO Wealth website, as well as the BDO YouTube channel. Our next edition of Talking Trusts will be hosted on 8 June at 11 a.m. And the talk is titled Marrying Family Governance with the Trust Deed. It really stands to reason that managing family wealth in a trust can get complicated if there is no clear structure governing the family vision, family members' roles and responsibilities, and the purpose of the trust. And so Trevor Dickinson will host part one, which will be a two-part discussion that will really explore normal family dynamics of marriage and divorce and how this plays out in the family governance and the family trust deed. So until then, if you have any questions relating to the administration of trust, please do reach out to BDO Wealth Advisers, and we will be glad to help you get to the right solutions. Stay well, stay safe, until we connect again. Goodbye.